What's up, guys? I'm nobody special. And I've had a couple of comments on this channel, and I've seen a couple of threads on Twitter where people have basically been talking about the Evergrande collapse and saying that it's not a risk to global markets or that everything is under control because China is doing this on purpose, that this is all being done deliberately. And there is some truth to that China is taking deliberate action that has resulted in the Evergrande collapse. However, history has shown that just because governments and regulators do something on purpose doesn't mean it's going to go well, and it doesn't mean it's a good idea. You ready? Hit it. Thank you for joining me. I'm Jack Gamble, and I'm nobody special. And a lot of people have been saying that China is doing this on purpose, that Evergrande is collapsing because China is doing this on purpose. They're tanking their own real estate market on purpose. And that's true. But that doesn't mean that's the right decision. That doesn't mean it's a good idea. In fact, China has started this policy called the Three Red Lines policy. It initiated it back in August of 2020 to try to cool their housing market. And the more I read into this, the more I start to see parallels with the U.S. in the lead up to the global financial crisis in the early 2000s. And I wanted to get into some of that today to kind of dispel this narrative that just because China is doing this on purpose doesn't mean it's going to go well. Before we get into that, guys, I have to ask if you could please remember to smash that transitory like button and subscribe to my channel. Hit that notification bell. It really helps me out. It helps this channel to grow and continue growing, and I would be forever in your debt. Now, with that said, let's shrink my big fat melon of a head. And I want to talk to you guys about China's Three Red Lines policy. When you hear people say that China has done this on purpose, that everything that's going on with Evergrande is part of some grand plan, this is what they're referring to. They're talking about the Three Red Lines policy. You see, China and really the world has known that there's a real estate bubble in China for the better part of a decade, right? All of these Chinese real estate shorts have been going on CNBC over the last few days. You know, Andrew Left and Jim Chanos, right? These perma bears, which a broken clock is right twice a day, have been going on CNBC and saying, "See, I told you so." And to their credit, they were right. But remember, when you're short, being wrong and being early is essentially the same thing, right? And that's a quote from The Big Short, right? When Michael Berry is with one of his investors, and he's saying, "I'm not wrong, I'm just early." And the guy says, "That's the same effing thing, Michael," because financially that's the same thing, right? When you short something, you have to be right about what and when, right? And that's why it's so hard for shorts to get calls right. Well, these guys like Chanos and Andrew Left have been going on CNBC, thumping their chest. "Oh, I called this. Yeah, you called it 10 years ago, okay? So no, you're not right. You just said the right thing way too early. That doesn't make you right. Anyways, China has known for a long time that they have a real estate bubble, right? Real estate is 20% of GDP in China and property development. This is a huge percentage of China's economy. Has to deal with building and real estate. And I also have to factor in that it is almost exclusively the vehicle for wealth and investing available to the average Chinese citizen. So this is big. I want you to imagine that all your 401k, your pension, your savings, everything is in your home. That's a big deal. That's what it's like in China because the stock market and the bond market are not very popular in China, and there are not a lot of options available to the average Chinese citizen. So a downturn in the real estate market is huge in China. It's huge. And one of the reasons why China has been unable to rein in the real estate market for the last 10 years, even though they realize they've had a bubble, is because it's so big. There's such forces at work in China that want to keep the bubble going. And they tried and failed. I believe it was in 2014. They tried to cool off the housing market and tried to put limits on how much debt the property developers could take out. And it failed, and they backtracked, and the problem just got worse, right? That just emboldened the developers to go out and take on more debt. So here we are today, August 2020. They institute the Three Red Lines policy, which is basically limitations on the debt that Chinese developers could take out. And I want to get into what those three lines are. And here they are right here. The three red lines, which represent basically three strikes, you're out. is a liability to asset ratio of less than 70%. And that excludes advanced receipts, Evergrande. So you can't take credit for your 20% deposits on buildings you haven't built yet. A net gearing ratio of less than 100%, and cash to short-term debt ratio of more than 1x. All right, so there's a lot of financial jargon terms in there. I don't want to spend too much time dissecting this, but let's just elaborate a little bit on what these terms mean. Liability to asset ratio, right? That is the amount of money owed versus the amount of assets on their books. Now, this is important with Evergrande. The liability to asset ratio had to be less than 70%, right? Your debt can't be more than 70% of your assets. Because I talked about this tweet from the Last Bear Standing, which, excellent Twitter feed, by the way. The Last Bear Standing on Twitter. I highly recommend you follow this account. This guy has nailed this call, and he is just fantastic. I don't know who he is. I've never met him or spoken to him, but this is great. So this chart right here that he said, the blue bars represent Evergrande's assets, and the orange bars represent their liabilities. And right here, okay, it looks like they have a lot of liabilities, but it also looks like they have a lot of assets. Well, the big problem with Evergrande and how they've treated assets is they've taken apartments that they couldn't sell, and they're just leaving them on their books as inventory in the assets column. The problem is if you can't sell it, you can't access that capital. So it's stranded money. It's no good. You're basically a beached whale. You can't move. And what Last Bear Standing did was he went and he took their inventory away from their assets. Now you see what this chart looks like here. Now look at this one. This is what that chart looks like if you take inventory off. All right, quite a big difference. So number one, Evergrande's assets, the assets that they say they have, not really. They were way overstated. But case in point, the one liability says that your liability, aka your debt, to your assets can't be more than 70%. And Evergrande has way more debt than assets. Way more, even if you include their inventory, which they can't sell. The other red line is a net gearing ratio of less than 10%. And gearing ratio is basically your total debt divided by your shareholder equity. And then shareholder equity, I have to elaborate on, is your assets minus your debt. So the gearing ratio is your total debt divided by your assets minus your debt. That has to be less than 100%. And again, that has to deal with the liquidity of the company and their ability to raise cash. And this is well above 100% for Evergrande. And the last one I want to talk about is the cash to short-term debt ratio of more than 1x. And under cash, that includes actual currency in accounts and things like T-bills, like immediately sellable assets. So apartments don't count on cash, but things like treasury bills, that could count. Divided by your short-term debt, and that would be any debt that is coming due within the following year. That also includes accounts payable, right? Bills to your contractors, all that. That ratio has to be no more than 1x. And so those are the three red lines that China established. I apologize for all the terms and statistics there. But suffice it to say, each one of these three red lines represents a measure of the financial health of the company as it pertains to debt and then cash and assets. And depending on how many of these red lines you cross, there are limits on how much debt growth your company is allowed to have in China. Now, this is why they say this was done on purpose, because China intentionally limited how big the debt could get. Now, the debt is already at a ridiculously high level for these developers, okay? So now placing limits on the annual growth of the debt does not solve the problem. It just forces them to deal with the problem today, okay? Which is debatable whether that's wise or not, right? I mean, here in the U.S., we've had a debt problem for generations, and we just perpetually ignore it. Eventually, that bird's coming home to roost. Maybe tomorrow, maybe next month, it may be 20 years from now, but we know it's coming, and we like to pretend it's not coming. So I will give China credit here. They realize that there's a reckoning coming, and they're forcing themselves to face it. So there is a wisdom in that. But that doesn't mean this is not going to be a big deal. So if you have crossed none of the China's 3 red lines, you're limited to your debt growth of 15% annually. That's important. So even if your company is in good financial health, you can only grow your debt by 15% a year. 1 red line crossed 10%, 2 red lines crossed 5%, 3 red lines 0% debt growth. All right. So what they did here is they basically said if you strike all 3 of these boxes, if you check all 3, you are allowed to take out no new debt, no debt growth. All right. And that is what forced the Evergrande issue. That is what put Evergrande up against the wall. All right. So again, when you hear that Beijing did this on purpose, that this is all part of some big master plan in China, yes, that's true. Okay. And, I saw this article came out today in Reuters. Beijing sets planned fires to save property forest. It's making China sound very wise and very forward-looking, right? And I hate the way American media does this. American media loves to bow at the feet of Chinese Communist Party members and kiss the ring because it helps to keep their publications circulating in China. And it helps them to maintain access to that massive market in China because the second you cross the CCP, you are denied access to their market of, 1.3 billion people? So, and CNBC is the worst of this. The way CNBC kowtows to the CCP just blows me away. We'll get into that a little later. But there's some things I want to mention in this article here. Again, this is basically saying that the Evergrande story is a brush fire that China has intentionally set. And while that may be true, there's some things I want to mention here. All right. President Xi Jinping wants investments to flow into industrial upgrades, not condominiums. But so long as property is seen as risk-free, it will continue to attract an inordinate amount of capital. So what that is saying is, number one, you've got this central planning. The government decides we want more industry than we want residential, which that may be the right case in some parts of the country, but it may also be not the right case in other parts of the country. It's one of my big problems with central planning is I think you leave those decisions up to the individuals and everybody is better off. But Xi Jinping wants more industrial upgrades and less condos. He wants China's energy to be put into making it this industrial superpower and to developing the exports and the mines and the productivity. But as long as property is seen as risk-free, it will continue to attract an inordinate amount of capital. And that gets into the moral hazard. Property is seen as risk-free in China because it is believed, and you hear it in most of the press here, it is widely believed that the Chinese government is going to bail out the developers. And while I personally believe that is the case, I'm not willing to stake my life on it. I would say it's a high probability that in some way the CCP bails out Evergrande, but I wouldn't guarantee it, right? There are percentage chances of one thing or the other happening here. And again, China has intentionally lit this brush fire, so that doesn't necessarily mean they're going to bail out Evergrande, right? If their intention was to face this problem head on, then that kind of suggests that they wouldn't bail them out. So that's something to keep in mind. Reading on, households, for instance, borrowed $1.2 trillion in 2020, even as income growth slowed, with most of that in mortgages. All right, so this sounds an awful lot like the U.S. in the early 2000s. Households taking on increasing level of debt in mortgages, even as the jobs market does not support it. Sounds an awful lot like the U.S. in 2005, doesn't it? The only way to change attitudes is to produce a controlled burn, as foresters do when they set planned fires to consume excess tinder and preserve healthy trees. Okay, well, that makes the CCP sound so wise and, that they're being proactive. However, they have waited arguably 15, 20 years too long to set this controlled burn. All right? And when your forest is full of gasoline and dynamite, there's no such thing as a controlled burn. So this controlled burn of theirs could very quickly turn into a raging inferno, and I think we're kind of starting to see that already. Things are certainly burning. A rhodium analysis shows 16% of the offshore dollar bonds issued by Chinese developers are yielding over 30%. And again, not investment advice. Don't touch a trade based on what you hear from me. I'm nobody special. Do your own research, your own DD, arrive at a decision that's right for you based on your unique situation. That being said, I talked about in a few videos ago, when you see something that is yielding 30%, run. Okay? A 30% yield means your principal is not safe. If there's a stock with a 30% dividend, it means that dividend is about to go away or that company is about to go belly up. Okay? And the fact that 16% of offshore bonds denominated in dollars of Chinese developing are yielding over 30%, that means 16% of those bonds are probably not getting paid. All right? 30% yield equals trash. Run. Reading on, share prices and listed developers have started plunging. Even before the latest rout, Evergrande was already down 85% this year. Buyers are holding back. Sales volumes in 30 large cities fell 32% year over year in the first 11 days of September. All right, you think there's a real estate crash? I want to read that one again. Sales volumes in 30 large cities fell 32% year over year in the first 11 days of September. All right. When we get housing starts or home sales that decline by like 0.2% or 0.3%, people say, oh my God, real estate bubble, it's popping here in the U.S. 32% year over year drop in the first 11 days of September. All right. There is a real estate crash happening in real time in China right now. Cue pressure on bank balance sheets. Unsurprisingly, perhaps manufacturing and services activity have lurched into monthly contraction. All right. This is an important quote. Manufacturing and services activity have lurched into monthly contraction. So that tells me that this is not just limited to China's real estate market. Okay, manufacturing and services are contracting. They're in a recession, all right? It has already spread beyond the real estate market. It's already hitting other areas, all right? So again, people saying China's got this under control, it's going to be this easy thing, they're doing it on purpose. Well, then why is it already spreading to other sectors of the economy? Okay, just because they did it on purpose doesn't mean it's a good idea. And nobody better illustrates this point than Jim Cramer over at CNBC. All right. Again, with Jim Cramer, there are guys who swear by him. There are guys who say he's awful. All right, what Cramer does is Cramer is the personification of market sentiment at any given time. All right, Jim Cramer will almost never go against the consensus. He doesn't stick his neck out. He will tell whatever the prevailing story is on Wall Street. He will say that on that given day. All right, if he's optimistic, it means he's read the articles and the majority of the articles he's read are optimistic. If he's bearish, it's because the majority opinion is bearish. Okay, He's not like this paradigm of wisdom that formulates his own opinion. He is just an indicator of market sentiment. So keep that in mind. However, I have to some of the things that Cramer says in this video really defy logic. Let's play this.
Big fail. Meanwhile, Evergrande's stock has been obliterated, and that pain is spreading to the rest of the Chinese real estate industry, to the Chinese financial sector, and to foreign banks with lots of China exposure. That tends not to be U.S. banks, just so you know.
All right. So what he said there, he's talking very fast. I apologize. He said, China's real estate contagion is already spreading into foreign banks with lots of China exposure. And he said that tends to not be U.S. banks. So what Cramer just said is the Evergrande situation is not going to affect U.S. banks. All right. On the surface, I get that, right? A contraction or, Evergrande's bonds defaulting is not going to affect directly, at least, BlackRock that has, 30 trillion or 12 trillion in assets under management, right? It's not even a drop in the bucket compared to a BlackRock. But Evergrande will affect other companies, will affect other banks. Those other entities, if they have major problems, could cause problems for U.S. banks. Case in point, take a look at like a Deutsche Bank, right? Big German bank. Has lots of involvement with the Chinese real estate market and with Evergrande, all right? So maybe JP Morgan and Citibank don't do a lot of business with Evergrande, but Deutsche Bank does. And if Deutsche Bank starts to have major systemic issues because of Evergrande, you better believe that's going to affect JP Morgan and Citibank over here in the U.S. All right? Because if we have any kind of counterparty risk at Deutsche Bank, oh my God, the net positioning and the gross of all of the positions at Deutsche Bank is beyond belief. If we ever see anything like counterparty risk involving an outfit like these European banks, you better believe that's going to spread across the pond like that instantly. And that'll happen faster than you can hit sell in your brokerage app. Trust me. Anyways, going on.
What does it mean? Evergrande is definitely a systemic risk for China, but I don't think that will do much damage here.
All right. Jim Cramer says Evergrande is a risk for China, but not here. But now listen to what he goes on to say.
However, there are certainly some sectors that will get hit. If Chinese real estate collapses, that's bad news for the metals and mining complex. And witness the breakdown in Freeport-McMoRan, that's a giant copper company. Plus, if this causes a full-on recession in China, then U.S. businesses with lots of Chinese exposure could get hit. There, you're thinking about the Starbucks, Estee Lauder, a Nike, Caterpillar, look, Tesla, even Apple.
All right. So again, this is what just blows me away about what Cramer said. First of all, he says, don't worry, it's limited to China. It's not going to affect us. And then he goes on to say, unless there's a recession in China, which we've already seen from the previous article, that manufacturing and services is slowing down. But if there is a recession in China, it might affect, companies like Freeport-McMoRan, Starbucks, Caterpillar, Tesla, Apple. Like he just listed like $4 trillion worth of market cap or, some ridiculous number. All the American companies that do business in China. You're kidding me, right? 20% of Chinese GDP is in their property development sector, in the real estate market. I mean, it's the majority of the wealth of 90% of the households in China. And it's getting wiped out right now. You better believe that's going to affect Apple and Tesla and Starbucks and anybody else who does business in China, which go through the S&P 500. They're all heavily vested in China. This is going to affect earnings of U.S. companies. Absolutely, unequivocally, without a doubt, this is going to affect earnings in U.S. companies so much that it could trigger a recession here in the U.S. It really could. And that's not a stretch of the imagination. That is how important real estate is to the Chinese market. And if you see the Chinese market slow down, it is going to affect our companies big time. Look at what happened with Apple. What was it? In 2017, in late 2000, no, it was 2018, in the one quarterly report, they mentioned like a 0.5% slowdown in iPhone sales in China. And the stock absolutely tanked, even though Apple had posted a monster earnings beat. It was a monster quarter, but they projected a mild slowdown in iPhone sales in China, and the stock tanked. All right? And I don't even think that slowdown ever even really materialized. Are you kidding me? A full-blown recession in China? It will absolutely spread here. Cramer is nuts if he thinks this isn't going to spread to U.S. companies. Nuts.
Don't flit in and out of it. It's not going to work, okay? I'm not worried about the U.S. banks. They've been pretty much shut out of the Chinese market anyway. We used to think that was a problem. Maybe they dodged a bullet. Cryptocurrencies also could collapse more than they have.
I agree with that. I think there is major risk to crypto coming out of China. But again, I've mentioned in my previous videos that I don't think, or that I do not adjust my crypto strategy based on day-to-day fluctuations or what I expect in China. I sold all of my crypto in 2017 when I saw the BitConnect video of Carlos from New York, and I said, that's it, that's a scam, there's too much fraud in Bitcoin, and I got out. And I was right. Bitcoin crashed. It went from the 13,000 or so that I sold it at, it went all the way down to 3,000. Of course, by the time I bought back into crypto, it was 23,000. So maybe I just shouldn't have sold at all to begin with, because I ended up buying back in at a higher price. So not my best trade. I was right. There was a price crash coming, but if I had done nothing, I'd be better off today. So, but I digress. So, you've got the U.S. press is saying China's doing it on purpose. It's not going to spread over here. I want to read you a couple of things, all right? First of all, take a look at this chart. This is the Federal Reserve's Fed funds rate. This, when you hear about Fed rate hikes, this is what you're talking about. And this chart goes all the way back to 2000, okay? I want you to focus here around 2004 to 2007, all right? This is Ben Bernanke raising interest rates every month. And why was he raising interest rates? Because he was trying to cool off the housing market. All right? Ben Bernanke wanted to cool the housing market. Does that mean that it was a good decision? Did things go well for us after that happened? You see, Bernanke saw the housing bubble forming, and so he decided he was going to cool off the housing market. He was going to start hiking interest rates to try to tighten restrictions on borrowers to try to prevent things from getting worse. Just like Xi Jinping has instituted the 3 red lines policy, all right? Well, Ben Bernanke did it on purpose. Does that mean it didn't blow up in his face? You bet it did. It blew up in his face. It blew up in all our faces. And I just want to read you some of the ridiculous quotes that came out of Ben Bernanke around this time frame. March of 2007, at this juncture, this is a quote from Ben Bernanke, former Fed chairman. At this juncture, however, the impact on the broader economy and financial markets of the problems in the subprime market seems likely to be contained. In particular, mortgages to prime borrowers and fixed-rate mortgages to all classes of borrowers continue to perform well with low rates of delinquency. All right? He said problems with the subprime market seems likely to be contained. Just like Jim Cramer saying, it's a problem for China, not for us. I want to read a few more of these. These blow my mind. Despite the ongoing adjustments in the housing sector, overall economic prospects for households remain good. Household finances appear generally solid, and delinquency rates on most types of consumer loans and residential mortgages remain low. This is in February of 2007. In real time, as the housing market is blowing up, he's saying, oh, delinquency rates remain low. We do not expect significant spillovers from the subprime market to the rest of the economy or to the financial system in May of 2007. So I'm reading you these quotes from Bernanke because I want to draw the parallel of, let's increase here. So you heard all those Bernanke quotes, right? And you could argue that the U.S., the Federal Reserve, created the global financial crisis on purpose. You could argue that because they hiked interest rates month after month after month for years to try to cool the housing market. They did it on purpose. They saw the problem developing and they thought they could get out in front of it. And what they ended up doing is they made it worse. They made the problem worse. What Bernanke didn't realize as he was hiking those interest rates was that there was this massive amount of these adjustable rate garbage loans that were out there. And what those adjustable rates did is they started with this low introductory teaser rate of 0% or 0.5% for the first year. And then after that teaser rate expired, your loan would be the Fed funds rate plus 2% or plus 3%. Well, Bernanke had driven up the Fed funds rate by 2.5 points, which meant these people's payments went from a few $100 to a few $1,000 like that overnight. He created those delinquencies out of thin air. And you know what? Maybe he was right to do it. Like the housing sector was obviously overheated. But does that mean he went about it the right way? Does that mean he didn't make it worse? No. He made it so much worse. Just like with Xi Jinping and the 3 red lines policy. Right? Just because China recognized that there's a problem and they're taking action doesn't necessarily mean they're doing the right thing. In fact, history shows when governments get involved in broken things, more times than not, they make them brokener. They make it worse. And that's what I think is going to happen in China. I honestly think the 3 red lines policy is going to make things worse. And Evergrande is only a preview. Again, we saw it yesterday with this company, Cynic. Their stock dropped 87%. They're probably going to default on their debt. There's these other companies like Fantasia that are now starting to show signs of problem, right? And you're already seeing the slowdown in manufacturing and services. You're seeing commodity prices are starting to crash. This is already spreading beyond the real estate market. So the next time somebody tells you this is all part of China's master plan, don't disagree with them. It is part of China's master plan. It doesn't mean China's master plan isn't stupid. Master plans in general are stupid. When central government officials get involved in the day-to-day lives of ordinary people and make sweeping, overarching decisions for everybody that pays no attention to the individual situations of all of those people and just decides this is right for everybody, it causes problems every time. Every time. And that's what's happening in China right now. Anyways, guys, that's all I got for you today. I hope you enjoyed this video. Thank you for your time. Please, on the way out, if you don't mind, smash that transitory like button, subscribe to my channel, hit that notification bell. It really helps me to keep this channel growing, and it helps me out a lot. I would be forever in your debt. Folks, in the meantime, live small and dream big.